Hello, savvy investors, and welcome back to the Dividend Uncle channel. These are difficult times for REIT investing, and in today's deep dive, we're exploring 3 blue-chip REITs that are trading below their post-COVID lows, an attractive opportunity for strategic investors. But before we get into the specifics of each REIT, let's set the stage with some context on why REIT prices are currently under enormous pressure, representing another setback for long-suffering REIT investors. Recent developments impacting REIT prices. The landscape for REIT investments has been clouded by higher than expected inflation in the U.S., leading to adjusted expectations for interest rate cuts. The Federal Reserve Chair just hinted at higher interest rates for longer, while some Federal Reserve governors now say that there may be no rate cuts this year. This could tighten financing conditions for REITs due to their high leverage. Moreover, geopolitical tensions in the Middle East have added layers of uncertainty, impacting global markets. Despite these challenges, it's vital for investors to stay focused on long-term potentials, as markets often price in such uncertainties prematurely. When even blue-chip REITs are not spared, it's time to pay attention. As we navigate through these turbulent times, it's crucial to identify opportunities where the market may have overreacted or overlooked the fundamental strengths of certain investments. Today, we'll take a closer look at 3 blue-chip REITs whose current market prices below post-COVID lows might not fully reflect their long-term value and resilience. Each of these REITs has faced unique challenges that have influenced their stock prices, making this a potentially opportune time to consider adding them to a diversified investment portfolio despite the underlying risks. Mapletree Logistics Trust. Starting with Mapletree Logistics Trust, this REIT is grappling with declining investor confidence amidst fears of cooling trade activities related to China and Hong Kong. Despite these challenges, it retains a strong geographic spread and operational capacity in key Asian markets. Its current price is trading just below its COVID lows, reflecting these broader concerns yet potentially underscoring a buying opportunity for those looking at the long-term growth trajectory of the region. Next, concerns over slowing consumer spending in Hong Kong have weighed on Mapletree Pan-Asia Commercial Trust, with its price falling to 19% below during COVID-19. While the performance of Festival Walk, its troubled Hong Kong asset, has been grabbing the headlines, it is worthwhile to remind ourselves that 60% of Mapletree Pan-Asia Commercial Trust's net property income, or NPI, comes from Singapore assets, especially the premier VivoCity shopping mall, the crown jewel of the trust. The amazing Swiss YouTuber, Marian Muller, who knows Singapore inside out, has this to say of VivoCity.
Really crowded shopping malls on the weekends. VivoCity is the worst.
With such a rare asset acting as the pillar of the trust, Mapletree Pan-Asia Commercial Trust will be able to rebound quickly as economic conditions improve in Hong Kong. This stark price reduction may offer an attractive entry point for investors betting on a rebound in Hong Kong and continued robustness in Singapore. CapitaLand China Trust. Lastly, challenges from the broader economic slowdown and real estate sector turbulence in China have pressured CapitaLand China Trust. CapitaLand China Trust is trading at 32% below its COVID lows due to persistent fears of an economic slowdown in China affecting the retail and logistics sectors. Despite these challenges, the REIT's focus on high-quality assets provides a buffer, and its current low price could be seen as an opportunity to invest in a recovery story, assuming a stabilization in China's economic conditions. The Dividend Uncle's take, a time to take calculated risks. While the short-term outlook may appear less optimistic, the investors who typically succeed are those who can look beyond immediate challenges to recognize long-term opportunities. With these blue-chip REITs, investors benefit from strong sponsorship, quality management, and high-caliber portfolios. However, it's crucial for investors to conduct their own due diligence, assessing the long-term prospects of the sectors and markets in which these REITs operate before committing their investment dollars. This careful consideration will ensure that you are making informed decisions aligned with your long-term investment goals. Conclusion. As we review these 3 blue-chip REITs, it's clear that while they face sector-specific and macroeconomic pressures, their current low prices relative to historical averages may present valuable investment opportunities. Remember, interest rates will eventually stabilize, and those REITs with strong fundamentals and strategic asset management could emerge stronger. Thanks for tuning into this comprehensive review. If you're considering making a move or just want to stay informed, don't forget to like, subscribe, And comment below with your thoughts. Remember, understanding your investments thoroughly is key to navigating these turbulent times confidently. Until next time, happy investing.